happy that we are going to listen your concern about this. And we are fortunate that we have participants from all over India and Japan. Lisa is from Tokyo. We are expecting some participants from Australia as well as from Pakistan. So we are hopeful that they will also join us. So maybe we can start the questions. Or my first thing is that being an economist, investor with a passion and experience in the impact investments, what are your views on the present COVID-19 crisis? How do you think that as an investor, as an economist, where the world is going? So your views on that, please.
Well, thank you for the invitation again. And if you're hearing, I'm getting a little background, so just everybody mute out a little bit. The Zoom technology is challenging. But let me just say that it's our contention that this crisis is going to lead to a complete reevaluation of Western economic thought and economics in general. Basically, the idea is that, we all know that this economic system has not worked as well as it should have for the vast majority of human beings who are alive and have been alive in these Western economic systems. It's worked well for a very small group of people. And what this crisis does is it puts that in high relief. It shows with certainty that that is the case. So what we think you're going to see is a reevaluation of capitalism, of markets, and of the market system in general, so that they're more humanistic, more representative of the needs of the majority of people. That would be the best outcome. There's that old joke about economists really coming out on both sides of an issue. We certainly could see the negative outcome of that, which would be a more restrictive economic system being put into place, a less representative economic system being put into place, where the concentration of wealth, which is the driving issue with respect to human rights around the world in capitalist economic systems, where that continues to grow. But we're hopeful. We're actually hopeful that so many people now are recognizing what the issues are, that they are going to demand a reformulation of economics and economic theory.
Yeah, so thank you. I think it's very interesting because we are also working the similar line, and for the last 10 years or maybe more than 10 years, we can see the whole world is running towards a more materialistic world. In India, like we say that you have to chase your lifestyle or you have to chase your life. So the point is everybody is chasing the lifestyle right now, more profit, more materialistic approach towards everything. And when I was going through some of your paper and you mentioned about the honest investment vehicle. So what do you mean by honest investment vehicle?
Well, this gets to the core of the work that you and others are doing so well around the world, really. By honest investment vehicles, we mean investment vehicles that fully account for both financial impacts and social impacts. The example, there's an article that I will share, I will put in the chat box where I talk about this. And the example that I use in that article is one of looking at, say, tobacco in the 1950s. If you looked at the financial returns that were coming off of Philip Morris and other tobacco companies, they looked pretty good. But what those financial returns did not do, they did not incorporate fully the social costs of that particular product, the health costs to the consumers of that product. And without doing that, that's not an honest investment unless you actually really fully account for the social and the financial impacts of an investment. Then it's not honest. And we've seen that in a number of recent situations. We're going to see that here with respect to the COVID-19 crisis. So that's what we mean.
I can see a lot of jargon these days, like impact investment, social venture funds, conscious investment, responsible investing. And on the other side, when I see that the organization like United Nations, which have as a division called PRI, Principle of Responsible Investments. On the other side, UN is also talking about the SDGs, and all respective government, they also talk about the bottom line approach. So do you think that in the last couple of years or last one decade, some good initiative has been taken globally where we can say that they are the motivating figures and not talking about the single bottom line, they are talking about the triple bottom line approach?
I do think that that's good. I think that that is, again, a reformulation of capitalism so that it fully represents the needs and the desires of a broad set of the population as opposed to a very small set of people, of human beings alive. And I think that's going to continue. I think you're going to continue to see that type of reformation, refinement of the economic theories. And because again, once again, we know that the old economic theories have not worked. This profit maximization, shareholder wealth maximization has not worked in terms of our key factor. And again, I talk about that in my slideshow, which I think is on the screen right now. Which is maximizing human life and maximizing positive aspects of human life. The current economic system, shareholder wealth maximization theories, again, work only if you own shares. You know, shareholder wealth maximization works only if you're actually holding shares. And we know that the majority of human beings alive on planet Earth right now, as we speak, do not hold shares. So that can't be a reasonable or rational approach to human life to maximize shareholder wealth when the majority of humans don't own shares. And now here's the other thing that I will say. Part of the issue that, part of our analysis really rests on what's going on here with respect to history. So shareholder wealth maximization was a fine theory 200 years ago. You know, it helped to develop markets, helped to develop economies, that sort of thing. It's not appropriate now. It leaves too many people out. Can you hear me? If you want to jump in, was that your last question?
Carry on, Michael.
Okay. All right, very good. So as you can see on the screen, what we're going to talk about today is conscious investing. We'll define that. We'll go through a number of terms. Now, in terms of the class itself, by way of introduction, we'll again look at benefiting the audience by providing new interpretations, definitions, and understanding of conscious investing and of the style of investing that we talked about. My name is William Michael Cunningham. I hold a master's in economics and an MBA in finance, both from the University of Chicago. I'm an adjunct faculty member at Georgetown. And I wrote the first book on something called crowdfunding and the Jobs Act, which is equity crowdfunding for small companies. We launched our website, creativeinvest.com, on November 16, 1995. We created one of the first green bonds, an energy efficient mortgage-backed security, in 2006. We also helped to create a style of investing called diversity investing in 2006. And we created a social impact bond which was a proposal to the World Bank to create a faith-based microfinance bond. And we did that in 2001. So that's a little bit of background. Now, in terms of what we're going to talk about today, we're going to talk about conscious investing. We're going to talk first about investing. What is investing? And then we're going to move on to what is conscious investing. Lesson 2, we're going to move into investing tools. What are stocks, bonds, and mutual funds? Lesson 3, slide 3, we're going to talk about conscious investing, why conscious investing and why now. And then we're going to roll into a summary of the class and present a roadmap for the future of this course. Now, our learning objectives are that people on this course will be able to understand what a stock, bond, mutual fund, what stock, bonds, and mutual funds are, know the differences between those vehicles, know what conscious investing is, and also know why conscious investing is growing. Also, our learning objectives for the entire class and for this class are to have attendees understand socially responsible investing, environmental, social, and governance investing, or ESG, and have a better feel and understanding for corporate social responsibility. All right, let's start. What is investing? Investing, let me go back here, I tell you, investing is basically putting money or something of value, like time, into an endeavor, a business, a project, real estate, etc., with the expectation of obtaining additional income or a profit at the end of that investing period. So if you look at some typical investment vehicles, the chart on the screen shows how they would have grown starting in the year 1801 to 2011. Let's go through these really quickly. Stocks, just the general stock would have gone from $1 to 10.7 million. And that's a representative of the index, of course. Over the course of that time period, 1801 to 2011, bonds would have gone from $1 to 24,385. Bills, short-term bonds, would have increased to $5,357. Gold only increased from $1 to $56.51. Again, this is from 1801 to 2011. And then inflation, the impact of inflation increases from $1 to what cost you $1 to buy in 1801, cost you $1801 to buy in 2011. Here, hold on, I'm getting a little chat. Okay, so that's investing, what investing is. So just looking at this, again, investing is expecting something of value, typically, but not always money, it can be time, is expending something of value with the expectation of achieving a profit or positive material result, getting more out than you put in by acquiring financially based arrangements, stocks, bonds, mutual funds, ownership interests, stock, property, a house or real estate, or by using the value that you put in, time in this case, to develop a commercial venture. Now, the key for our class is as follows. You must recognize that the traditional set of investing options is limited, and it's wrong, since these typical investing options typically do not allow for investing with an eye to social returns. So women's empowerment, the rights of minorities, etc. The typical set of investing options are silent on those types of factors. And what we're seeing, what the Institute is about, what we're about, is expanding the set of investing options to more fully incorporate social returns. And we'll define social returns at a later point, but that's the key issue, the key problem. So our intended outcomes for lesson 2, we're going to talk about what a stock is, what a bond is, and what a mutual fund is. So what's a stock? A stock or a share of stock is a legal representation demonstrating ownership in a company. Each share denotes a part ownership for a shareholder, stockholder, share owner, stockholder, or shareholder of that specific company. Stocks, some stocks, not all, but some stocks can be traded on exchanges. If they are traded on exchanges, then they're identified by their ticker symbol. For example, General Electric, a large company in the US, is identified as GE on the New York Stock Exchange. Now, there are different types of shares. You have common stock, which represents a general ownership interest in a corporate entity. Preferred stock, which has certain rights and rights to cash flow. And then there are unlisted stocks. But these are the typical types of shares. Most shareholders purchase common stock. But you got to ask the question at the time of purchase. You should know whether you're buying common or preferred or some other type of share. Again, the goal is to have a monetary balance at the point of sale or at the end of the investing period that is greater than what you had at the start, and or have a monetary dollar amount at the end that is greater than the impact of inflation. So we looked at inflation from 1801 to 2011. We saw that it was $18.01. We looked at stocks. We saw that the typical index of stocks grew from $1 to $10 million. So obviously, if you had invested in stocks, you definitely would have beat, and by beat, I mean made more money at the end of the process, had more money at the end of the process than the impact of inflation, which was $18.01 versus 10.1 million. So clearly you did better than inflation in that scenario. Now bonds. What's a bond? A bond is a form of debt. Bonds are loans or IOU, but you, the bond holder, serve as the bank. You loan your money to a company, a city, the government, and they promise to pay you back your money in full with regular interest payments. U.S. Treasuries are bonds issued by the U.S. government and are considered the safest bonds in the world. Well, they were prior to our current administration. I'm not sure where they are. Certainly their consideration with respect to safety has fallen a little bit given the current administration. Now, Treasury bills or T-bills are short-term bonds. So these are bonds that have a maturity of less than, let's say, 1 year. So agency bonds, I'm getting a little notice that my internet connection is unstable. So if it comes in and out, let me know. All right, moving along. Let me come back here. We're still on bonds. Municipal bonds are bonds, IOUs, or loans that are issued by states, cities, and local governments. In the US, municipal bonds aren't subject to federal taxes, and also they may be exempt from state taxes. Corporate bonds, on the other hand, are bonds that are issued by companies. They are subject, by the way, to federal and state taxes, corporate bonds, that is. The goal, once again, is to have a monetary balance at the point of sale or at the end of the investing period that is greater than what you had at the start, and or to have a monetary amount, dollar amount, at the end of the investing period that is greater than the impact of inflation. So moving on to mutual funds. So mutual funds are, a mutual fund is an investment vehicle made up of a pool of funds collected from many investors for the purpose of purchasing mainly securities or assets such as stocks, bonds, money market instruments, or similar types of vehicles. Mutual funds are operated by money managers who invest the fund's capital in an attempt to produce gains and more income for the investors. Now, the key metric for mutual funds is a term called the net asset value. And the net asset value is the price per share or the per share value of that pool of assets. The per share dollar amount of the mutual fund is calculated by dividing the total value of all of the securities in the mutual fund's portfolio, subtracting out any liabilities, by the number of mutual fund shares outstanding. So if the total value minus liabilities of our mutual fund is $100, and if there are 10 shares that are outstanding, that means that the net asset value would also be 10. Just take 100 divided by 10. So the net asset value is computed once a day and is based on the closing market prices of the securities in the mutual fund's portfolio. Once again, the goal is to have a monetary balance at the point of sale or at the end of the investing period that is greater than what you had at the start, and or to have an ending balance that is greater than the impact of inflation. So let's just go over what we just went over. Stock is a legal representation demonstrating ownership in a company. Bonds are loans or IOUs. You serve as the bondholder, as the bank, and a mutual fund is a pool of funds collected from many investors for the purpose of purchasing mainly securities. Now, I'll stop here for a second and see if we have any questions.
I believe Mr. Deepen Modi has a question for you.
Yes, I see that in the chat room. It would be great to know your thoughts on the relevance of social return on investment as an investment metric. So social return, remember at the start, I talked about how the failure of capitalist systems rests on their inability to incorporate social factors into the computation of the value of an investment vehicle. Social return on investment is one attempt to try to incorporate those social factors into an investment valuation. And I think we're just beginning the work to develop a consistent social return on investment framework. The issue is that everybody has different thoughts on what social factors are, number one, defining them, and then number two, how they impact value. So remember the Philip Morris or the cigarette example? You know, I said that the issue with Philip Morris and tobacco companies is that their share price did not fully account for the damage that their product caused to human life. So social return on investment might actually calculate that, might say, all right, look, the value of the company is $100, Philip Morris, and the damage that they've done to human lives in terms of lost wages or pain and suffering is $50. So that would mean that the actual social, the value of the company incorporating social return would not be $100, but it would be $50. So that's a real simple example of the start of the calculation of social return on investment. Then we've got to roll through a number of other factors, which we think we can. And one of the reasons that social return on investment is a relevant and germane concept now is because we have a lot more data now on the social impact of investments. We created something called the fully adjusted return methodology back in the back in 1990 that started to incorporate and calculate these factors. But there are a lot more data sources now that you can use. Things like the UN PRI or SDG goals, which are rapidly promoting the development of the social metrics with respect to the impact of investments, the social impact of investments. So there's a lot more data now that you can use. Now, the second question concerns the current scenario. When the market is down, is it a good time to buy stocks? I would say yes, but it depends upon the stock, of course, the geography, where you are. But in general, and for the most part, and again, looking at that chart from 1801 to 2011, that chart tells you that over the long time period, stocks have tended to be the best investment. Now, again, not all stocks, but in general, stocks have tended to be the best investment. There's no reason to believe that with stocks down now, that over the long run, 10 years, 20 years, 30 years, 40 years, 50 years, that stocks won't continue to be the best type of investing vehicle. All righty. So we'll move on now. I think we've, we'll take more questions at the end of the presentation. So now let's talk about conscious investing. We're going to define conscious investing, ethical investing, social responsible investing, environmental, social, and governance investing. And we'll also talk about corporate social responsibility and that style of investing. So let's get started here. Conscious investing. What is conscious investing? It's a style of investing and a way of earning returns in the financial markets by supporting commercial activities and other efforts that are creating positive returns. I wouldn't say change, I'd actually edit that a little bit, but positive change in the world, or in some cases that may not be creating positive change, but aren't making the world worse either. So let's go over that again, because it's kind of important. It's a way of earning money, earning returns in the financial markets by supporting commercial activities and other efforts that are creating positive regard. I wouldn't say positive change. You don't necessarily have to change anything. All you have to do is support positive activities in the world. Now, let me skip to that last line there. Conscious of what? Human life maximization without regard to race, religion, geography, gender, or wealth. That's what we're talking about here. You're conscious of the impact that your investments have on the quality and the length of human life for the broadest number of people on planet Earth. Yeah, so that's that is what we're talking about. Now, conscious investing shares some similarities with social responsible investing, with environmental, social, and governance investing, and with corporate social responsibility investing. In that, they all of these investors, they basically mean similar things, if not the same thing, but they want to reach their financial goals in ways that coincide with their values. That's the typical definition, but one of the things you have to think about is this. Let's say you're Rush Limbaugh or some other extreme right-wing investor, where your values might include alcohol and tobacco and all kinds of human slavery. There are investors out there that have the approach that all of these, what we would consider to be negative activities, are fine if you can get paid for them. So you have to be careful when you talk about investing in ways that coincide with values, because not all values are the same, not all values are positive. We're talking about positive investing choices and positive values. And by positivity, what we mean is human life maximization without regard to race, religion, geography, gender, or wealth. I'm not sure that in the extreme right-wing example that I used, that you could say that those values lead to human life maximization. If you're talking about utilizing tobacco, alcohol, firearms, you know, all of those sorts of things. So that's the difference. The human life maximization and quality of human life maximization is the difference between conscious investing and non-conscious investing. Non-conscious investors don't care about human life, quality of life maximization or human life term maximization. All they care about is the money. It's just short-term gains. They don't care about anything else. They just care about the money. A good example of this would be one of the things we've been studying has been the British imposition of the opium trade in China, for example. You know, one of the companies that was the leading proponents of that is still around, you know, and all they were concerned about, this is, 200 years later, all they were concerned about was short-term profit maximization. They didn't care about the damage that they did to Chinese society and to their own society. So that's an example of, from our perspective, non-conscious investing. So conscious investors make investing decisions that are usually part of an overall strategy for ethical living that includes making values-based decisions about work, where you work, how you work, and about consumption choices, what you consume as a participant in the economic system of the world. You use these values-based decisions to help guide your consumption decisions. So it's a long-winded explanation, but there's a lot to it. And by the way, this is not the definitive explanation either. There are other ways of looking at this. So let's move on. So again, remember, we said the goal of investing is to have a monetary balance at the point of sale or at the end of the investing period that's greater than what you had at the start, and or to have a monetary dollar amount at the end that's greater than the impact of inflation. What we see with conscious investing is that it guides how you're going to approach having that monetary balance at the point of sale that's greater than what you had at the start. Conscious investing is all about how you get there, getting there in a way that is supportive of the positive aspects of human life. So again, we'll take questions at the end, but if anybody has a real quick question. Okay, hearing none, we will move on here. So, oh, wait a minute, we've got, looks like we got one question that popped up at the end, okay, I got you, okay. So the summary for right now is, we talked about conscious investing. Conscious of what is the key question? Human life maximization without regard to race, religion, geography, gender, or wealth. What you're talking about is making life better for the maximum number of human beings who are alive on planet Earth right now. It's a huge topic. It's very ambitious, I understand. But again, this is why we think this crisis will lead to a complete reevaluation of economics to make it work better. But we know that the current distribution of wealth, the current economic theories with their focus on short-term shareholder wealth maximization, social impacts disregarded, we know that that does not work for the majority of humans on planet Earth right now. Conscious investing offers a way to start, just to start to consider some of these social factors in your investing decision making. And we think this is a game changer. We think this is much needed. We think this effort is going to continue as people around the world. Not only, that's why I'm so pleased to be on this call. Obviously India has long led the way in terms of economic and social return analysis. So it's entirely appropriate that this this style of investing, this way of thinking would be incorporated into training in your country. So for more information, you can email me at info@creativeinvest.com and also see our blog post on the economic and social costs of reopening the economies. I'll just say a quick word about that. What our economic models do is we look at, again, the truth. We look at honest investing, and to determine the impact of opening the US economy, what our models do is look at a domestic terrorism incident in the US called the Black Wall Street incident, and we look at the impact that had, how long it took for that community to regenerate. All right, so I think we are at the end. We've got a couple of questions.
Please feel free to unmute yourself and discuss it with Michael, whatever questions you all have. The round, it's open for everyone to talk.
So let me congratulate Michael for a wonderful presentation. I think it's quite eye-opener for all of us. And I can see a lot of very interesting question. The question which Dr. Upadhyay is asking is, I think that the same question I would like to know. Companies who create maximum damage to Mother Earth invest maximum in CSR. Should we invest in them or not?
Now that's a great question, because part of what's going on is that, remember I mentioned that there's more information now, there's more data, but crises like the 2008 crisis and this crisis lead people to question the social performance and social impact of companies. Now, companies are not stupid. They're run by very smart people who, recognizing this new consideration, will do what's called greenwashing. They will pretend that their corporate activities are positive when overall they are not. So they might do something good, make $1 million donation to an orphanage, while at the same time ripping off consumers for $1 billion. And we saw this happen with respect to one US bank called Wells Fargo. And you should look them up to get a feel for their negative corporate behavior. So, well, here's my thought about that. And fool me once, shame on you. Fool me twice, shame on me. Yes, these companies are very good, and a lot of their CSR, social impact investing efforts will look very good. They'll do a very good job of actually hiding the damage that their corporations are actually causing. So if you get fooled once, don't beat up yourself. Hey, a lot of people got fooled by these corporations because they're so slick. But what that says is that you have to maintain a focus on uncovering, don't believe the hype, to quote Public Enemy, a rap group in the US. You have to maintain a focus on continually uncovering and evaluating corporate performance. Understand that, as I said, these guys and women are smart. They know that there is value to appearing to be a good corporate citizen, and they are going to create false narratives and false efforts that showcase their corporate entities as good when in fact they are not. So you have to keep looking. There's just no way around that.
Yeah, the second question, I think that Lisa, who's from Tokyo, she's asking that how much is now conscious investment in the total investment? If you see the ratio, this is my, I think that understanding.
Yes.
If I see the
I do.
ratio of ethical or conscious investment and non-conscious investments.
Well, certainly conscious ESG, social responsible CSR investing is growing by leaps and bounds. You know, I would, and there are some tools and some entities that you can use to answer that question. As a matter of fact, let's take a look at some of those. I'm going to switch over to my, yeah. I'm sure you can kind of see my screen now. So let's go to take a look at that. One of the groups that I suggest you take a look at is the Interfaith Center on Corporate Responsibility, ICCR. Now, they publish a number of reports that help to, oh, you can only see the slide. Can you see the screen now? Can you see the website now? You should be seeing the ICCR website.
Oh, you can see the screen, summary of training.
Oh, okay, all right. So let me go back to that because I'm on the I'm on a website now. But oh, I think what I have to do is I have to stop that and then come back. Bear with me. All right,
And,
now can you see ICCR?
Yeah, we can see that now.
Okay, so this is a group that has been around for a number of years, and what they do is they look at corporate social responsibility from a number of areas: corporate governance, climate change, responsible finance, food justice, health, human rights, investor action on COVID-19, you see here, and water stewardship. So one of the things they do is they publish a lot of information that is designed to answer that specific question of the total investment pool out there. What percentage of it is devoted to conscious investing? I would say off the top of my head, it's been growing. I'd say it's probably about 20% of the total. If you looked at the total pool of investment dollars out there, it's got to be about, I don't know, $100 trillion worldwide. You know, I'd say that probably about 20% devoted to what you would call conscious investing, social responsible investing, ESG, corporate social responsibility types of efforts. But again, that's changing. You have some issues with greenwashing and with fake, you know, kind of fake numbers being in there, but it is definitely growing. Now let's take a look at the, okay, so I guess everybody can see that now. Now, do we have any other questions?
So participants, please ask. I think it's a good opportunity to discuss and have an interactive session now. So I think that they are getting ready for the question. So can I ask you some question which are not covered in the presentation?
Absolutely.
Because I can see I have gone through your profile and I can see that you are working on the financial technologies also. And for the last 2-3 years, this blockchain technology and Bitcoin, which is financial technologies, you have mentioned that there should be acceptance in the global market for the good. So what you have to say, because in India, the blockchain technology is open, but Bitcoin kind of technology, crypto technology is not, is legalized. And there are so many countries which are not open to the cryptocurrency. So what do you have to say about this, the future of Bitcoin and the cryptocurrency, especially for the human development?
Well, certainly we think that Bitcoin, and hopefully you can see the screen. I'm going to a comment that we posted to the Reserve Bank of India on Bitcoin and on, there it is.
Yeah.
So blockchain is a new technology that basically allows financial transactions to be disintermediated, to be taken out of the financial institution framework that currently governs most modern economies. Now, what do I mean by that? What I mean is that Satoshi, the person who created Bitcoin, created a way that you can implement and execute financial transactions without depending upon regulated financial entities, because he recognized that those entities did not represent the interests or the human values of the majority of people, that the increased concentration of wealth was leading to a very narrow focus in terms of interests, and that it was damaging people long term. So he created, and the technology allows you to do this now. He created an entirely new approach to implementing transactions. Again, we talk about it in this letter and on this press release, which I'll post to the chat box. Let me do that right now. So we think that this is a hugely important and hugely positive kind of technology that was developed because of the failure of conventional financial institutions and their regulators to operate and to regulate financial institutions for the benefit of a broad number of people. Basically, what happened is that regulators and who were supposed to govern financial institutions so as to maximize social return, social benefit for a population, those regulators got captured by the industry that they served, so that they started to represent only the interests of those financial institutions and not the broader interests of entire populations. Blockchain technology was created in direct response to that, to, again, create a way of executing financial transactions that did not depend on these large, flawed, unrepresentative financial institutions. It is a brilliant, brilliant technology. You know, we talked about it in 2006. We talked about how competitive advantage with respect to capital access is available to any country with significant economic potential and a modest telecommunications infrastructure. So, you know, we kind of saw this coming. We didn't know it was blockchain, you know, we didn't design, but we said, look, the technology is out there so that you can create new ways of having access to capital. And the reason why you need new ways to have access to capital is because the old financial institutions don't allow access in the way that they should. They don't allow broad access to capital. They've limited access to capital to a very narrow group of people. And that's just wrong. That's inimical to social return for the broad global economy. So Bitcoin, blockchain, was created to address that issue. Now, for those who want more, as you see, I've gone to our blog and I'm going to do a search on blockchain. We did a primer on blockchain. Here it is, summary of Bitcoin and its underlying technology. Blockchain, I will post this to the chat room too. I would encourage you to take a look at this if you want more. Here we go. If you want a summary and an understanding of blockchain and Bitcoin itself. But basically, we think these technologies are the future. We think they are a perfect response to the failure of large financial institutions and the regulators that are supposed to govern them to look out for the interests of the broadest number of people who are their customers. You know, instead, these institutions started to look out for the interests of a very narrow group of managers, owners, and shareholders. And again, most people are not shareholders. So I would take a look at the comments that we posted to the Reserve Bank of India on blockchain and on digital technology. Basically what we said was that we would hope that the Reserve Bank of India would really get involved in this new financial technology and make that financial technology available to other countries, countries in Asia, countries in Africa, take a leading role in this new cryptocurrency, new digital currency, digital technology. Because if they don't, then we know that, you know, other countries, other institutions that might not have the world's best interests in mind will start to dominate those areas. That will lead to a lowering of social return.
So I think it's a wonderful presentation on blockchain and crypto world. So thank you very much. We have some question on the chat box.
Yep.
I think if Dr. Upadhyay and Arpit, if you can ask direct to William, that would be great.
Sure, can I ask? Hello?
Yeah, please go ahead.
Michael, we are in a dilemma here. What has happened that in name of Corona, Indian government has created a trust which is not to be audited by government auditors, and which is also not very transparent and not in public domain. So we really feel like it's in the name of Corona, they ask CSR money for donations. How should we react to it?
Yes, we're seeing that in the US too, of course. I think you're referring to things like the Fed's activities where they're taking $500 billion and giving it to corporations, and they don't want any kind of transparency. They say basically just trust us. We know what we're doing. Is that what's going on in India too?
Same. Yeah.
Wow. Yeah, that's a reaction of this concentrated pool of money that controls the economy. They are worried. So let's take a step back. What's going on here? All of these financial institutions, the people who have the concentrated wealth in their hands, they are very worried about this crisis because they know that this could lead to a complete reformulation of the economy as people recognize that these entities have too much power, they have too much control, they don't represent or look out for the human interests of the broad population. I think what you have to do is you have to keep asking questions, you have to keep pinging, keep pushing on the door to get answers. I would suggest, and also publicize the issue, because I was unaware until you said something that the financial regulators in India were doing the same thing that the Fed is doing in the US, which means that
Yes.
you're probably seeing this in a number of other countries too, where these central banks are taking these, what are public assets, public resources, and devoting them to a very narrow group of companies. The idea being that we're saving the economy by saving these companies, as opposed to taking a broader, more expansive view of what's beneficial for society as a whole. They're using their old playbook, which is in their defense, it's all they know how to do. All they know how to do is to dump money into a small group of people that they know. Everybody knows. So I think what you have to do is you have to push for transparency. You have to, again, highlight the fact that this is occurring. Blog posts, newspaper articles, videos on YouTube, TikTok, Instagram, all of these new media tools that you have to get this story out. Make sure that people understand that this is going on. Look for global cooperation with people like myself and others who, again, now that I know this is going on in India, I'm going to look to see where else around the world this same style of policy is going on. And I'm sure when I look, we're going to see that it's all over the world where these central banks are doing this small scale effort to concentrate assets in fewer and fewer hands. So we'll make that aware. We'll make people aware of it. What we did with the Reserve Bank of India was we just sent them a letter. There was no reason for me to send them a letter. I don't have any official capacity or position, either in the US or in India, but we saw their regulatory notice and we just sent them a letter and actually got, some pretty good feedback. The consideration of that letter was very good. Not that they changed the policy, but at least we, were able to get our thoughts in. So I think that's about it.
Arpit, would you ask your question, please?
Yeah, sure. Thanks, William, for such an insightful session. So I just wanted to ask, the COVID-19 has crashed the financial market up to a great extent. So will the COVID-19 recovery, it will open avenues for ESG investing going forward? I mean, will investors look more forward to invest in the ESG funds and the conventional funds? Since, people will now take in record the ESG risks before they invest. So what do you feel? Will this be the new normal for the people who are investing, or?
Yes, I think it will be. I think consideration of social factors will become standard as people they think about the impact that commercial activities had on COVID-19 and the response of commercial entities to human needs in this time of crisis. Let's face it, most commercial entities have not stepped up to, some have, but most commercial entities have not stepped up to the plate in the way that you would want them to step up in the face of this crisis. Again, in their defense, they just don't know, number one. Number two, they're populated by managers who all buy into the shareholder wealth maximization school of thought and theory. And under the shareholder wealth maximization school of thought and theory, during the COVID-19 crisis, what you should do is shepherd and selfishly keep all of your resources to yourself. That's what the traditional economic theories say. Should you reach out? Should you make donations? Should you do anything extraordinary for the broad population? No, that's going to cost you money from a corporate perspective, number one. Number two, you don't know how long this crisis is going to last. Number three, you don't know what the ultimate impact of the crisis is going to be. So from the traditional old school corporate governance type of attitude, you should be really very, very selfish under those circumstances. That's what the theories say. Now, we know that that is wrong, that that's short-sighted, that is exactly wrong. And one of the things that we think investors, and more importantly, consumers, are going to judge companies based on how well they responded to human needs during this time of crisis. So if you're, remember, we had the former CEO of Wells Fargo come out and say, and that's in one of the articles, he came out and said that people should go back to work so that the economy will do better, and that some people are going to die, but hey, that's the way it goes. We think that that's wrong, and I'm putting up the blog posting here. We think that's wrong, and we think that these, here you go. The guy said he wanted people to go back to work and see what happens. Some may even die. I don't know. The ex-CEO of Goldman Sachs wanted those with a lower risk to return to work in a few weeks. This was a few weeks ago. So we know that these are just greedy and unpatriotic institutions whose defining characteristic is a lack of empathy. Remember, when we, when we talk social and conscious investing, what we're talking about is a feeling of empathy. Do unto others as you would have them do unto you. Look out for the common good. That's empathy. That's the definition of empathy. And what we have a bunch of corporate leaders throughout the 80s, 90s, 2000s, who were selected based on their lack of empathy, based on their selfishness, based on their greed. You know, that's what's driven us to this point. And we think that you're going to see a reversal of that attitude where yeah, it used to be that being greedy and being selfish was regarded in the 80s and in the 90s as a positive factor. We think that's exactly wrong now. And we think companies are going to be evaluated based on their understanding of the social impact that they have, broadly speaking, and their performance in helping to make that social impact positive. Is that clear? Was that helpful?
Yeah, that was insightful. Thanks.
Okay. All righty.
So, okay, then it has been wonderful to hear all the knowledge that you've shared with us in a short duration of time. I'd like to thank you. I'd like to thank all our participants over here to ask such an intriguing question. And I'd like to thank Mr. Anil Jaggi
Yes.
for being such a wonderful host for us, and more so Mr. William Cunningham for taking time from his busy schedule and being a part of the session. And I'm also thankful to him that he has accepted to offer a course with IICSR, and we'd like to share a 10% discount coupon. It's available online, and we will email it to all of you all. So thank you, William.
No, thank you. I'm really delighted. Thank you to all of the participants and to our co-moderator here. I'm always cautious about pronouncing names because, you know, I always butcher them, you know. But Anil, I hope I can call you Anil. Thank you very much. Thank you to all the participants. I am really looking forward to further interactions. And thank you, Harsha, of course, with IICSR in your group. I think what you're doing is very, very important. You know, we've got to get this international dialogue and training going in this area. So thank you again.
So thank you all of you once again. Thanks, Harsha, for organizing this.
Okay, now take care.
Thanks.